Welcome to Multibagger Shares. I'm Manish Goel, SEBI registered research analyst, and today we are going to talk about one of the most destructive biases in investing: loss aversion. Loss aversion is a concept from behavioral economics discovered by Nobel Prize winners Daniel Kahneman and Amos Tversky. Their research showed something remarkable. The pain of losing 1 rupee is approximately twice as intense as the pleasure of gaining 1 rupee. This asymmetry is hardwired into our brains, and it silently destroys wealth for millions of Indian investors every single day. Let me explain how this works in the real world. Imagine you buy a quality stock at 200 rupees. It rises to 300 rupees. A beautiful 50% gain. But then, it dips to 280 rupees. That 20 rupee decline from 300 feels like a punch to the gut. Even though you're still up 40% from your purchase price, the fear of losing those gains becomes so overwhelming that you sell at 280, locking in a 40% gain. Then what happens? The stock continues its upward journey to 500, 800, even 1000 rupees. You captured 40% instead of 400%. This is the devastating cost of loss aversion. Now let's understand the science. Kahneman and Tversky's prospect theory, published in 1979, identified 3 key properties of how humans evaluate gains and losses. First, reference dependence. We don't evaluate our investments in absolute terms, we evaluate them relative to our buy price. Second, diminishing sensitivity. The difference between gaining 10,000 rupees and 20,000 rupees feels bigger than between 1 lakh and 1,10,000, even though both are 10,000 rupee differences. Third, and most importantly, loss aversion. The value function is steeper for losses than for gains. The loss aversion coefficient is typically estimated at 2 to 2.5, meaning losses loom roughly twice as large as equivalent gains. Let me give you a real example with Titan Biotech. BSE code 524717. Currently trading at approximately 454 rupees per share with a market capitalization of 1877 crore rupees. This is a debt-free company with strong fundamentals, a ROAS of 16.9%, and promoters who have been increasing their stake from 48% to 55.87%. Imagine 2 investors who both bought Titan Biotech at 200 rupees post-split. Investor A, the loss-averse investor, panicked at every 5% deep, when the stock corrected from 350 to 310. The pain of losing 40 rupees per share was unbearable. He sold at 320, booking a 60% gain. But the stock continued to 454. And investor A missed an additional 42% of upside. Investor B, the disciplined value investor, recognized that short-term fluctuations are noise. With a business showing 28.6% APE CAGR, expanding margins, and management increasing their own stake, the fundamental thesis remained intact. Investor B held through every dip and sits on a 127% gain today. The difference? Not intelligence, not education, simply the ability to override loss aversion. There are 5 devastating traps that loss aversion creates for Indian investors. Trap number 1. The break-even obsession. You buy at 500. It falls to 300. Instead of asking whether the business is worth 300 today, you fixate on 500, your reference point, and refuse to sell until it comes back. As Warren Buffett says, the stock does not know you own it. Your buy price has zero impact on its future value. Trap number 2. Premature profit booking. This is perhaps the most expensive manifestation. You double your money and sell. Then watch the stock become a 10-bagger. Peter Lynch documented that most of his best returns came from stocks held for 5 to 10 years. Trap number 3. Portfolio checking addiction. Research by Bennett C. and Thaler showed that investors who check portfolios daily are far more loss averse. On any given day, the probability of seeing a loss is nearly 50%. But over a year, quality portfolios are overwhelmingly positive. Every red number triggers a stress response. The cure: check less often. Trap number 4. Averaging down on fundamentally broken businesses. Loss aversion makes selling a loser unbearable. Instead, investors throw good money after bad. The correct question is always, if I did not own this stock, would I buy it today at this price? Trap number 5. The F&O gambling trap. After suffering losses, the pain drives investors toward futures and options for quick recovery. But SEBI's own study reveals that 9 out of 10 individual traders in the equity F&O segment incurred net losses. Loss aversion creates a vicious cycle of escalating risk. Now, how do you beat loss aversion? Here are 5 proven strategies. Strategy 1. Think in terms of intrinsic value, not price. When you anchor to a company's intrinsic value based on earnings, cash flows, and competitive moats, price fluctuations become irrelevant. And remember what Warren Buffett says: wide diversification is only required when investors do not understand what they are doing. When you deeply understand a business, you have the conviction to hold through volatility. Concentrate your portfolio in your 5 to 10 best ideas, not 50 mediocre ones. Strategy 2. Pre-commit to holding periods. Before buying, write down your thesis and intended holding period. When fear strikes, read your thesis. Has anything fundamental changed? If not, hold. Strategy 3. The would I buy it today test. Every time you feel the urge to sell, ask yourself, if I did not own this stock and had the same cash, would I buy it today? If yes, hold. If no, sell regardless of gain or loss. Strategy 4. Reduce portfolio monitoring frequency. Switch from daily to weekly or monthly checking. Your future self will thank you. Strategy 5. Study quality businesses deeply. The more you understand a company's fundamentals, its ROAS, its cash flows, its management quality, the easier it becomes to hold. Titan Biotech exemplifies this with zero debt, rising promoter stake, and consistent earnings growth. The greatest Indian investors, Rakesh Jhunjhunwala, Radhakishan Damani, Vijay Kedia, all held their best positions through enormous drawdowns. Jhunjhunwala hailed Titan Company through multiple 30 to 40% corrections on his way to earning over 10,000 crore rupees from that single position. His loss aversion did not disappear. He just had a system for overriding it. To learn more about value investing, watch our complete free course on our YouTube channel. The link is in the description. Remember, the market does not reward the most intelligent investors. It rewards the most disciplined ones. Stay patient, stay invested, stay focused on quality. This is Manish Goel from Multibagger Shares. Thank you for watching. Disclaimer: the author Manish Goel is a SEBI-registered research analyst. Registration number INH10004775. And Multibagger Shares is a SEBI-registered investment advisor. Registration number INA10007736. This video is for educational purposes only. Please do your own research before making investment decisions. 9 out of 10 F&O traders lose money according to SEBI. Focus on quality stock picking and long-term value investing instead.